While we were waiting for the others, guys, we'll have Brittany Green today, our certified valuation analyst, and please prepare any questions that you might have related to evaluating a business or business valuation.
Absolutely. Yeah, no, I love that we were able to do the topic this way where you guys submitted the question, because I run out of things that I find or other people would find interesting, because I find stuff about valuation interesting, but I geek out about it and you guys may fall asleep and take a nap for the next hours. So doing it this way, you guys let me know what you want to hear about, allowed us to completely customize this. So I love it.
Yes, actually, we recently updated the format wherein we're shaping the call based on our accelerators' current questions, hurdles, or whatever they're experiencing.
Awesome.
All right, I think we can get started, and
Okay.
we'll just wait for this to happen.
Cool beans. All right, awesome. Well, let's see. We're using Google Meet, so you guys will have to be a little bit patient with me. I'm going to do my best to do this correctly. So we're going to do this. We're going to do that. We're going to share this. Okay, so we're going to make this full screen, and then we're going to swap that, and hopefully I can, whoops, hold on. I'm going to move you guys to a different screen so I can make sure that, aha. Okay, can you guys see a PowerPoint presentation that says bridging the valuation gap?
Yep.
Okay, yep. Awesome. Well, I'm going to move my mail off my desk because where I had to move you guys, I can't see any of your beautiful faces. So if I'm looking this way, it's because you guys are over here on this screen and presentation is here. So as always, anybody who has heard me before, if you have questions, please stop me. I'm going to try and keep an eye out for the if any questions pop up in the chat and all that good stuff. I did not include an introductory slide this time, but as Andy mentioned, my name's Brittany Green. I'm a certified valuation analyst and owner of Green Appraisal. So business valuation is my game. So when Andy had emailed me a couple weeks ago about doing this, we talked about, hey, what's the burning question of the week? And so the question ended up being directly tied to our topic here of bridging the valuation gap. Okay, so let's see, are you gonna let me? There we go. So here was the question that Andy sent me. So the acquiring entrepreneur encountered a situation where the broker is saying that there is an $800,000 gap between the SBA valuation and the seller's asking price. Not a big shocker there. The broker is attributing this to actions that the owner took in 2022 to reduce taxable income. Now, if the AE believes that the intrinsic value of the business is actually closer to the asking price, what options do we have to bridge the valuation gap without injecting additional equity? So absolutely love this question. I spent the weekend with it, spent some time with it, and we're going to go over a couple of things. Now, I actually stole this next graphic from a friend of mine off his LinkedIn today, but essentially this is what happens. The broker thinks that the lender is too low and the lender thinks the broker is too high. And this is kind of where valuation gaps tend to appear. And if there's anybody who is a Marvel fan as opposed to a DC fan, sorry, this is the best one that I could find. So, so really it is kind of the fingers are getting pointed at the other, right? So you as the buyer kind of feel like you're stuck in the middle while mom and dad are fighting, right? So how do we actually fix this? So we're going to look at first understanding the valuation gap. So anybody who has not encountered this before, we're going to go over what is the gap, how do they go about doing valuation, all that good fun stuff. And then we're going to look at well, from my perspective, what's the best first step? And then we're also going to look at the additions to that. And then we're also going to look at some different options that you can bridge the gap without doing that equity infusion. Okay, so first up is the valuation gap. Now, the SBA, when it comes to valuation, when they get a loan request, they're going to go to whomever it is that they have contracts with to get a valuation conducted, okay? There's a bunch of different firms out there that do this. There's national companies, all of that. I have even done some of this work as well, where the bank literally engages you to do the valuation. So there are certain things that we have to follow within SBA guidelines for arriving at a valuation of a business or the fair market value. Now, we do look at all three methods through that, But one of the things that we find with SBA valuations is that they typically provide us tax returns as opposed to financial statements. I have always campaigned to get financial statements because I think it is a more realistic view of the business, but typically the banks will provide the tax returns. Now, on the flip side, the seller's asking price. Now, anybody who has heard me present before, I am a huge fan of due diligence. If you're buying or you're selling, especially if you're selling, have a good exit plan, do a valuation, because then it actually makes the process easier because you have something concrete to use as your valuation. Some people will utilize a broker. It sounds like that might have been what happened here. The broker assessed the value of the business. That's what they ran with the asking price. And that's how we end up with the valuation gap and why we ended up with, Spider-Man versus Spider-Man. So this is typically how valuation gaps occur. Is SBA is using a valuator to assess value, typically based off of tax returns. A broker is typically assessing the value of it, utilizing some kind of multiple that they heard from somebody on how to arrive at a value. So one of the things that was in the question is something called intrinsic value. It's not something that is a common term, so I wanted to make sure we covered that today. It represents the true value or true worth of the business, considering some core fundamentals. Essentially, it's perceived goodwill of the business. So components of intrinsic value are going to include competitive advantages, customer loyalty, brand strength, management quality, barriers to entry, market position. It's going to be a bunch of different things, right? So all of these that you see listed here, competitive advantages, customer loyalty, management, all of this, it's not something you can put a direct number onto or a direct value onto, right? So it's a little bit more of a, that's why we call it goodwill, is you're applying an arbitrary number to it. Now, don't get me wrong, there are models out there that go through and do assess. You can put, weighted averages or weighted numbers to all of these different things to arrive at a value to get there. There are components to going about doing this, but essentially for the purposes in this context, intrinsic value is the magic number of the seller, right? They think that, an example, I don't know if anybody here is in Houston where I'm at, it's the difference between buying a mattress at the mattress store and buying one from Gallery Furniture from Mattress Back. So if Mattress Back was to, he's a huge, basically celebrity, but he's a businessman here in Houston. If you see him, you know who he is. He's just an absolute fantastic person, gives a ton back to the community, right? So there's a difference between buying a mattress store or buying Mattress Max, mattress store. If you're buying his, he knows that if he's the one answering the phone, somebody's more likely to buy the mattress from him versus a regular mattress store. That would be intrinsic value, is the value of the business with him included in it. So best way I could try to explain that in basic terms. And if you haven't heard of Mattress Back, look him up. He's hilarious. I'm sure he's on the YouTube. So now, coming back to our Spider-Man, how do we actually settle the question of value? The easiest way to go about doing this is to get a neutral third party second opinion of the value of the business. Okay, so SBA has theirs, broker has theirs. Let's get a neutral third party opinion as to what the value is. Now, why is that my go-to on this? It's because we're actually going to look at the same methods of valuation, but from a fresh approach with knowing, I don't have the SBA lender over top of my shoulder. I don't have the broker over top of my shoulder. I don't even have the buyer really over top of my shoulder. I have financial statements and we can go from there. So we're going to look at the income approach. Discounted cash flow looks at future potential. Capitalization looks at historical performance. And we can look at some financial health insights as well. We can also look at a market-based approach, which we would take it into consideration. Market approach is like when you're buying a house, you look for other comparables compared to your company. Now, there can be a difference between the SBA valuator and your independent valuator on the market approach, because they could actually use a different source to find the market multiples. There's about 6 different accepted organizations that provide us market comps. So if that valuator used PratStats and I use BizComps, we're going to arrive at a different market approach based on where we sourced our information from. Okay. Now, finally, there's the asset approach. And the asset approach is sometimes uses like a sanity check to check your other 2 methods and make sure you're kind of on the right path. But here's the thing with asset approach. And I actually had this conversation with somebody this morning specifically surrounding this. is that the asset approach is how much do you own minus how much do you owe, and that's the value of the business, right? So if you own $1 million worth of assets, but you owe 1.1, how in the world can you still have an asset valuation? Through this process, as valuators, we have the ability to go in and make adjustments to the assets or to the liabilities. If the company is carrying a $70,000 or $100,000 shareholder loan, that one's kind of an easy one to write off because theoretically it wouldn't carry forward, right? So there's certain things under the asset approach that we can make adjustments to. And again, it's a difference between where the SBA valuator was, potentially where the broker was, if they made an assumption on what the value of the business is, and the third party. So by using the independent, we've looked at all three methods of valuation. So we looked at income, we looked at market, we looked at asset. Here's the other component. And not every SBA evaluator will do this. I always have, because I like having the whole story, is that you can actually construct a narrative around the business's case. So the thing right now is that the SBA sees one thing, the seller sees another, and you as the buyer, you see a lot of potential in this business, right? So through this process, we can actually do a background interview with the seller. I've even done it with the buyer to understand what are the anomalies. So through generating this story, we can explain what happened in 2022. Who was the professional? What was the goal behind it? What were the changes that were made? What were the long-lasting impacts? What was happening before that? It allows us to understand the entire story going into it. And then was there any operational changes after that? So, or was it just a tax strategy and there were no operational changes? Or, did it actually spark them being able to make some differences? Whatever it is, we want to understand that to be able to explain that in the narrative. Once we've done that and explained that in the narrative, then that can go back to the SBA lender and be able to say, hey, here's what we saw. This is what we understand. Because a lot of the time, it's like whenever you're talking to your kids, right? And you're trying to find out which one actually spilled the milk. Was it them or was it the cat? And you're like, well, no, the cat did it. And they're like, okay, well, kind of tell me the story. Well, whenever you ask, well, did you spill the milk? No, the cat did it. But then, okay, dad comes in and then they ask, well, what happened with the milk? Gonna be a different story because the question's been worded differently, right? So that's really what we see is we're able to show the situation a little bit differently and hopefully give a better example, right, to the lender. Not that I'm trying to belittle a business and calling it milk on the floor, but you guys got where I was going. I'm an analogy storyteller. So another component that we can do through building the narrative is to justify any cash flow or forward-looking cash flow. Once we understand the changes that they made, we can actually see what probably some of their assumptions were that could potentially be enhancing the value, which is where they're seeing at $800,000 higher than what the valuator did for the bank, or even what the bank saw whenever they did their analysis. So we can actually kind of help be able to build more of that story to say, okay, this is what we did. We saw this, we're seeing this projection. We picked up this client, there's this contract. We've diversified the amount of people that we talk to, and it's resulted in a 5, 10, 15% increase in sales, which equated to X amount of dollars per year. It really hasn't cost us any extra dollars as far as expenses go. It only costs us X amount of dollars extra per month, and that's where we arrive at it. So the more explanation and more storytelling we can do in evaluation, the easier it is for whomever is reading that to understand and move forward. So the thing with us in valuation is our valuation reports are built to stand on their own. So whoever reads it doesn't have any questions, right? But in my opinion, in the years I've been doing this, is that you can explain what's going on, but without giving any actual assumptions or story, right? I want to fully understand everything around the business. So whenever we put in that explanation, everything is there and there really are no questions. We understand how the company started, how it operates, what changes they made, who did they actually utilize. This is what we see as far as cash flow. This is any potential issues we see from risks. And that's how we arrived at what we arrived at, okay? So if we still have a value gap, okay? We've gone through, had the third party opinion done, The lender doesn't want to budge because they have their numbers that they're going to do. They're like, no, I'm not going to do it. But you as the buyer, you still want to buy this business. The seller doesn't necessarily want to come off theirs because, you know, we've been able to justify something through the third party or through the second opinion. What are our other options to bridge the value gap? Now, there's kind of these 5 different ways to do it without adding any extra equity, because that was kind of the key, right? So you're not coming out of pocket. How do we do that? First step is going to be seller financing. Now, I have seen seller financing be just the value gap difference, and I have seen seller financing look at the entire thing altogether, and the buyer did not actually use the SBA for any of their loan. They just did the entire seller financing through the seller, to where there was a percentage put down up front, and then, you know, they had a contract that went out explaining the rest of the terms, you know, so on and so forth. So the seller becomes the bank. We saw more and more seller financing in the last probably 2 years since we saw interest rates with the SBA be absolutely crazy pants. Like, we were seeing some people get interest rates of like 13, 14, 15%. People didn't necessarily want to pay that high of an interest rate for a loan. So seller financing almost became more normal in the last couple of years. So this isn't as much of a new idea as it has been historically. So this is something that's not as crazy. You're going to hear me say this after almost every one of these. If you're going to do some kind of seller financing, make sure you have a contract. So make sure you are in contact with a really good contract attorney, business attorney that can help you walk through all the things, because they're going to see things and know things that you or I are like, oh wait, yeah, no, I didn't think about that. So 100% find yourself one. If you don't know one, I know a lot of good ones. Let me know if you need a referral. So next out, an earnout structure. So earnout structure is the payments are made to the seller over time based on contingencies. So this structure actually is a bit of a, it reduces the risk for you as the buyer. Okay, so what it does is you're willing to go to the seller and say, hey, seller, SBA is willing to give me X amount of dollars. You want this much money. I'm willing to pay you what you want. But here's the kicker. If it's going to be $800,000, we're going to need to do this on an earnout structure. Potentially the seller stays on board for a year, 2 years, 3 years. I was actually on the call with an OBGYN here in Houston. He's willing to stay on for 3 years to do the earnout, to kind of pass the baton for his patients to the next doctor. So there's some industries where you want that earnout, or for where that seller is there to do that easy pass off. There's some industries where it's not necessarily needed, like restaurants or something like that. If I'm going in to get good chicken parm, I don't care who owns it as long as they didn't change the recipe, right? So that's not necessarily an earnout needed industry. But if there's a price difference and we're talking a restaurant, that could be part of your structure. So it helps you be able to, it helps the owner or the seller stay involved and be like, and kind of make sure that the company stays successful for you, but also it's a protection from you for a risk perspective, so that if it doesn't hit those benchmarks that you both thought it was going to, you have some contingencies in place to where you're not coming out of pocket for a whole another $800,000. Again, contracts are key here. To make sure that all of this is done, you'll probably also want to talk with a finance professional to make sure what benchmarks do you want to do? How is that going to be structured? What are those things that you're going to look at to verify yes or no? Yes, it was successful. No, it wasn't. What is owed? What's not? Okay. Now, deferred payments. So deferred payments is more of a structured payment schedule. So it does the purchase price over several years. This is great for you as the buyer, again, because it makes your payment schedule a little bit more manageable and gives you a little bit more flexibility. So it helps you reduce the need for immediate equity injection. So you're not having to put in that immediate equity. You're not having a whole lot of financial pressure, but you're going to get deferred payment. You know it's coming, so you can plan for it. It's kind of like whenever you buy furniture or something like that, and you have like 24 or 72 months of, you know, interest-free financing. You don't have to make a payment yet. They did that with my cars when I bought them. I didn't have to make a payment for like 30 days or 60 days or something. I knew the payment was coming, so I could prepare. It was just a deferred payment. So again, similar situation. If you're buying a Volkswagen, you're buying a business, sometimes you can work yourself out some deferred payments. Now, you can also adjust your deal structure. So Most business deals that we see are sometimes an asset purchase, to where you're purchasing the assets of the business. In this kind of situation, you could actually looking at doing a stock purchase instead. I would 100% have some conversations with your attorney, with your tax professional, potentially a broker as well, to understand what are all of the possible options and implications here. I have seen them be very successful, but sometimes there is an additional level of risk when you look at stock, because you then become you're on the hook for the liabilities as well. So it takes an additional layer of kind of digging in to find out if this is the best method. So this is kind of like almost, I'm not gonna say last ditch attempt, but it's not the typical answer that we see, but it is an option, depending on how excited you are. Now, the last method that we can see as far as, bridging that gap is recasting the financials. If you've already utilized a third party, you have that new version. Those financials have probably already been recasted, and if it's somebody like me, I've used financial statements versus tax returns. We've made any adjustments. We've taken out any one-time payments. We've taken out any add backs as far as personal expenses, made any adjustments to rent or payroll or whatever. All of that has been redone, right? So if you have a good relationship with your lender, then you can have a conversation with them to say, hey, we went to an outside third party. We engaged them to do this valuation. Here's the recast financials that they have. Would you mind taking a look at this and see, can we work something with the deal? I have seen lenders that will accept this and they will look at it. I have been on the receiving end of these as the evaluator, working with the bank, of receiving recast financials. Understanding the source of where they come from is key. The recasted financials that I ended up taking a look at was like an internal accountant that made the adjustments of the seller. So it ended up looking a little bit more like a kind of like they were trying to save their own skin and get the additional money. So the lender really didn't budge much on the recast. But if it's coming from a neutral third party that has nothing to do with the business, sometimes they will actually take it into consideration. A lot of the time, the lenders want to make the deal. It's just there's some kind of sticking point there that just is kind of stopping them from taking that next step. So sometimes if you provide this and then they can have a conversation with their evaluator, sometimes they can make those adjustments or see if there's any changes that they can make. If something makes sense and the case can be made, sometimes that can't happen. I'm not going to say that it's going to happen every time, but because it's all dependent upon that bank, there's credit scores, there's all kinds of things that go into their decision as to if they will or won't, but it's at least something, it's an option to have a conversation with them on. So again, possible options: deferred or contingent payments. So that is 100% the seller having confidence in the business to be able to do those type of transactions. Do understand the SBA does have rules regarding seller notes. So if you are going to do a seller note with them, so do part SBA, part seller note, you do need to have that conversation with the lender and let them know what exactly it is that you're doing, so that you can make sure everything adheres to the proper SBA rules, because we want to make sure all of that is kosher. And then the other one is looking at earnouts with the seller notes. So, that way they're not necessarily influenced or one way or the other. You can, the seller is also invested in your success. So my information's here at the bottom. I'm going to copy paste it. I'll drop it in the chat as well. I went through this pretty quickly, like in about a half an hour, because I did want to leave you guys enough time to be able to chat with all of you. Stop sharing. There we go. I don't think you want to see you guys yourselves. So what questions do you guys have in this situation? Richard came right out of the gate. I love it. How are you? Deferred payments. Have you seen the seller wanting a net present value calculation factored in? Richard, break it down for me a little bit.
Okay, so if he's going to get paid out in 5 years,
sure,
that payout, the money that he paid in 5 years, has a lesser value than it does today. So if anybody said, okay, we've got an inflationary factor of 5 over the next 5 years, therefore that payment's going to be bigger than it was.
Sure.
Not X number of dollars.
Okay. Yeah. So we have seen this on occasion. Usually, sometimes when we see seller financing or, a deferred payment schedule, it's sometimes more involved in a family transfer. So if the parties involved know each other, we don't necessarily see that. But if it's, independent third parties that don't know each other, sometimes they can have that in there. But again, that's why we always recommend having conversations with like the accountants or the attorneys or whomever, to see what's there. Because it's 100% something the seller can request, right? They be like, okay, if I'm going to wait 5 years to get paid, I want to see a little bit of interest on the deal. It's 100% something they can request, and it can be a negotiation point. But great question. We don't see it every time, but we have seen it on occasion.
Okay.
Yeah. But great question. I'm kind of curious whose deal this is. I don't know if anybody's going to be like, it's mine, because I'm just fascinated. Like, I want to know more. Like, I had so many questions after I saw this. I was like, I want to ask, like, send Andy like 15 more questions just because I'm nosy and just helps me understand things. So,
hey, Brittany, I have a question.
I hopefully have an answer.
How do you think about valuation when the EBITDA has changed a lot over the years? Most recently, really good EBITDA, and before that, okay EBITDA. For example, I'm looking at a business that has 2 or 3 years of 400K EBITDA, followed by $1.1 million of EBITDA last year, and they're saying that $1.1 million of last year is not necessarily repeatable because we won some big projects. Right, so they're admitting, hey, we're not going to do 1.1, but they're saying, but we should get credit for it because we did do that. So you can't just ignore it. So how do you think about handling that?
So for me, it's 100% about adjustment. And I'm going to tell you, I'm a cash flow girl. When it comes to valuation, cash flow is my preferred. I think it is a more true representation of the value of the business. Okay. I'm going to tell you 2 things that for me are true value of the business. Number 1, cash flow, like an income-based valuation, as well as that valuation being based on financial statements versus tax returns. Tax returns are built to make a company show that it lost money. And if we're basing a valuation off of something that lost money, we're not necessarily seeing the most accurate view of the business, right? So that side quest here to answer your question, Eric. So because I would take a look at this, I would want to see what is their current performance. So let's just say that was at the end of 2024. It's now the middle of 2025, right? We've hit the halfway point. I would want to see a year to date understand how valuation works for us. If we're doing a full detail valuation, there is a specific valuation date. Okay, so it's December 31st, 2024. I can't take anything in consideration after that date. If I'm doing calculation of value where it's a little bit more fluid, I would request year-to-date information to see where is it sitting at now. That's going to be the biggest indicator of how much weight I'm going to put into that 1 year almost anomaly of information, because if it was a 1-year contract or a multi-year contract, so if you don't mind me asking, you said they won more business, is it a multi-year contract or is like one-time or
one-time projects?
One-time project, so it's done in like less than 12 months.
Yes.
Okay. So, the question for me, because my business coach brain kicks in from, historically being a coach, my question would be like, what were the things you did to get that boost? Like, if you had that much extra business, what happened in this year for that to happen, right? I would want to know the reasoning behind it. Like, what did you do differently? Because then you can find out if it is repeatable. They're telling you it's not, but obviously they did it. So there's something to that. I would want to know what was did a process change? Did they just have a really good salesperson? Did the marketing finally work? What was the trigger, right, to get it there? If it's not repeatable, I would actually make an adjustment to the future projections to reflect the lower what it was, kind of like almost kick out that 1 year, not necessarily kick it out altogether, but remove that growth and make it more level with what it has historically has been. I have to do that with expenses quite often. Rarely do we have to do it with sales, but I have had to do that before, mainly in a startup kind of company that they got an infusion of cash and they did a whole bunch of stuff. And so they did really well, but then it started kind of like drifting off because they spent all that money. So answer your question? I'm long-winded when I answer questions. I'm sorry.
Yeah. So, we're taught, I guess, to buy the business for what it's going to do going forward, not what it's done in the past.
Bingo. Yeah.
So it sounds like if it's one-time projects, it can't be repeated.
Mm-hmm.
You don't want to tell the seller you're throwing it out, but you really you don't want to pay for that. And I agree with that. My thought is they already got paid for that. The cash from that year is in their pocket. But if it's not repeatable going forward, I don't want to pay for it.
So I would tell you, Eric, and we can 100%. I'm sorry, guys. I told you I would put my stuff in there, and then I didn't do it. If you want to have a conversation offline, we can 100% do that, just to kind of like walk through what that looks like. Because what I would do is I would adjust the future revenue to reflect what was the growth before that. Because I would want to see what was the growth in, like, let's just say 21, 22, 23. What did the growth look like over those years? I want to see what happened for 2024. Like, what was that jump? But then I'm going to come back and normalize it. We had to do this once with a company out of DC that this had happened to them, where they won a really huge contract. It was only for 1 year. It wasn't anything. They couldn't pick up another one after that. They were trying to get more, but it just didn't happen. So we actually did have to do that adjustment. But the key here is while they had that big jump in the revenue, they took on certain expenses to be able to do that. Did the expenses adjust back down to what they're doing now? Because if they're still spending like they were last year, there's potential profitability issues for it in the future if spending didn't adjust to what the sales are now. That's my other kind of back of my brain concern when I hear that.
Makes sense. Thank you.
Absolutely.
In the Brittany, in the previous example,
Sure.
The valuation gap, is the SBA, from what I understand, SBA, according to what Alan Peterson was saying, they're really only going to look at the last full year, up to the last full year of data. And if your justification to say, but based on the way that 2025 is going, if we look at the monthly figures and everything,
Mm-hmm.
That intrinsic value is closer to the asking price. Will that ever land though with an SBA lender, or are they going to say my hands are tied? I can't consider anything
Sure.
like the TTM data that's not full year.
Right. Yeah. I'm going to give you an answer I hate to give. Okay. So know that. It depends. It depends. It's 100% on the lender. Okay. How badly does that lender need to lend? Right. In the last couple of years, lenders needed to lend. So there were certain things that they were willing to take into consideration. So a lot of the times that if it's something, that's a small sticking point for the lender, they'll typically tell you, hey, if you can you get this, or this as far as documentation goes, right? Or would the seller be able to provide us X? If they can get that kind of information, like if they're willing to take, typically they won't look at 2025. They're going to ask for year to date just to see what is their performance. But, for the underwriting department, they're typically looking at historical. But, I've like I said, I've worked with lenders. I had one where the broker and the lender, these two got in an absolute shouting match at each other over the value of the business, because there was a value gap. And the buyer was ready to buy it. Seller was ready to sell it for what it was. And the lender was like, hey, I can only do it for X amount of dollars. We got involved to do the valuation for the bank. And, we got on calls with them, be like, hey, this is what we see. This is what we understand, because the seller was adding back in some stuff that the bank couldn't add back in. Right. It's just went against what they had. So it's your relationship with the bank a little bit, but it's also, how badly do they need to do a loan? How well is the seller working with the lender to provide documentation? There's so many different components that go into it. Now, have I ever seen a lender make a decision because they saw year-to-date information be that impressive? They're like, oh, okay, well, since it's here, yeah, we'll do that. No. Can they use it as a little bit more proof of something's kind of on the fence? Yes. Like that could be the tipping point if it was a fence line thing. Now, $800,000, that's a pretty wide fence. Like we're talking the Great Wall here. So that year to date's not going to tip them over the edge, right? Outside opinion could potentially do it, because then there's two valuations that state that, you know, that there's more documentation backing up the higher amount versus the lower.
Yeah.
Okay. Richard, on a deal that has real estate that's part of the selling price, do you add the real estate value and the value of the business to come up with the valuation? If so, do you use real estate appraisal for the value of the real estate? Great question, Richard. We see real estate involved a lot. So for us, the value of the business is separate from the value of the building. So we do not tack on the real estate to our valuation. What ends up happening is that the buyer or seller will take our valuation in, they'll take the appraisal in, and then the bank will structure it however they want to, as far as adding it or keeping it separate or whatever. A lot of the times whenever I'm doing a business, like if I'm on the sales side and I'm doing due diligence for the seller to do an exit plan, so I just did this about 2 weeks ago, is that they will, the building and the land is typically owned under a different entity that is not this business. So let's just say that the business is, you know, ABC LLC. The building and the land is typically owned by XYZ LLC. So it's actually a different entity that owns it completely. So I don't touch it at all. Our recommendation is always to find an appraiser. If they can't find an appraiser, talk with a commercial real estate agent that can get those comps for you, to where you can provide some kind of documentation surrounding it. Then the bank will actually request the appraisal from there. But no, the real estate is never added in. Like, I'm not saying, okay, this business is worth 1.4 million, but when you add in the $1 million for the building, it's actually at 3. That's not listed in my valuation report.
Okay.
Yeah. I did real estate appraisal before I was a coach, and there's not enough money in the world to make me go back to real estate appraisal. There's a lot of drawing and a lot of measuring, and yeah, I put in my time on that one. I did that for like 11 years, and then I was a coach, and now I do this. So I much prefer this. It's much more air conditioned. You know, Houston, we're like, it feels like 103 outside right now. So I'm good being an air conditioned office. So, but yeah, no, great question, because real estate does come up quite often. We actually get called in by commercial real estate agents to assess value of the business, because they want to sell the entire thing, and they can't assess the value of the business, fortunately. So they realize that they have to bring in the experts. So what other questions do you guys have? I love this group. You guys always bring great questions. We always have great discussions. So.
If you end up deciding that you want to put more equity in, take on investors, if you don't know, that's fine. But is it the case that my understanding was that then if the investors own 20% or more of the business, then they're going to be asked for a personal guarantee from the SBA. Do you know if that's true?
I don't. It sounds accurate, but I'm not 100% sure. It does 100% sound like something that they would ask. Okay, so investor over how much? I'm sorry, 20%.
20% was the threshold I had gotten my hands on that.
Of the valuation gap. Okay.
No, of the company.
Oh,
so
of the
if you
company.
say, you know, we can't overcome the valuation gap, so I'll fill it with equity. But then in order, you know, for the minority shareholders to, you know, get their returns upon exit, they end up having to own. That ends up causing them to own 20% or more of the business. I think the SBA then asked them for personal guarantee, which is probably going to be a non-starter for
Yeah, that's a solid question. I'm actually going to reach out to a couple of my SBA lenders and be like, hey, I was just doing this meeting and I got a really good question and I don't know the answer. So once I find out from them, I'll send it to Andy so she can get it to you guys. Because that's a solid question. I don't know. You know, while I know a lot about SBA lending, I don't know everything about SBA lending. So, but it is an interesting question. I know, and plus they've just changed some of the standards as well. So in the last couple of months, so that would 100% be something I can get clarification on and get you an answer back on for sure.
Thank you.
Absolutely. Yeah. Ben, you have your video on and I appreciate it. It looked like you were typing a question earlier. So I was like, I never saw it come through. So do you have a question, my dear? No? Okay. Sorry, I got to pick on you because you're like literally showing up on my thing.
He turned it off.
He was not saying that he turned his camera off. I was like, I am embarrassed. So I'm sorry. I'm the kid that sits at the front of the class. So, you know, it's like I'm always the first one with my hand up too. So, you know, it's just like that's just me. So if you're showing up in my front row, you're fair game. But yeah. Awesome. Okay, anybody else have additional questions? Even if it's a deal that you're working on or something weird that you saw or something you heard or whatever, I am here to answer.
I do have a question about valuations. So
I knew it.
Well, I had to process it. When you do your DCF valuation, I assume you're forecasting cash flows into the future and doing some kind of an NPV calculation to come back at the value of future cash flows. How many years into the future do you typically forecast cash flows?
5.
5?
Yes. Yeah.
Okay.
So we will go to the end of year 5 there. So historically, for me to be able to do a DCF, I only need 2. I like 3 to 5 historical. But no matter if I've got 2, 3, 5, whatever, how much historical, I'm still going to go to the end of year 5 for my cash flows. So right now, like mine are 2025 through 2029. So if I'm doing that calculation, I'm doing a calculation of value. So like I'm doing the basic program, not a full detailed under our company. Not every valuation firm is like this, but this is it. Offering 2 products helps us be able to help clients out. So under that process, I'm going to request a year to date for 2025. So 2025 is going to match up pretty closely with how they're performing now. So free cash flows projected will be 2026 through 2029 because 2025 is based on where they're at right now and that annualized out. And then we go from there. Because our terminal value is also calculated by the end of year 5. Which is another component that I'll go into the cash flow. Now, to Richard's comment about inflation or like allowing for, you know, what is the cost of the dollar going to be like in 5 years? We call that a growth rate. And right now, the growth rate for us is at 3%. There were some that were getting up to 4%. Based on just kind of inflationary things, you know, cost of gas, cost of eggs, cost of everything. Some people went up to 4. We never went up to 4 because we just didn't see enough of it happening. It fluctuated too much, like up and down and sideways. So we stayed stagnant at 3% for that growth rate. So that's what we're also taking into consideration for part of that discount rate. So capitalization rate plus the discount or plus the growth rate is going to give you a discount rate. So we're going to do free cash flows at the end of year 5, terminal value at the end of year 5. That's going to take into consideration the discount rate. So we pull capitalization rates through Kroll, then we add in, which used to be Duff and Phelps, add in the growth rate, and then we'll take free cash flow plus the terminal value plus the most recent year's cash, which would be 2024, deduct any long-term liabilities from the most recent year from 2024, and that's where we arrive at a value. So that's where, you know, when I talk about asset valuation, we can make some adjustments is that because we had this happen, shareholder loan was the majority of the long-term liabilities. So we actually were able to back that out and add it back in because they could just write it off for the purpose of the sale. It wasn't, the long-term liability wasn't to like a car or company or something or a bank or something like that. It was to themselves. So that's what we take a look at in a discounted cash flow. Did I break your brain?
Yeah, the last part. So you said you forecast out 5 years. You discount back.
Yes.
The sum of those cash flows, and then what did you say? You added that cash flow to the terminal value.
To the terminal value. So terminal value is the value of the company at the end of year 5. So however far out you're going. So if it's 3 years, 5 years, whatever, terminal value looks at the last year. What is the value of the business at the end of year? So for us, the end of year 5. So if you guys will indulge me for 1 second, I can actually show you what one of our calculation sheets looks like to help you visualize a little bit more if that would be helpful for you.
Yeah.
All right, let's do this one. Okay. Nope, that's not what I want. Well, you know what? I'll use that too. Valuation report. Where did my valuation report go? There it is. You know how you get like super organized with the way that you name your files and then you can't find it whenever you need it? That's what just happened. Richard, I see your question. Give me half a second. Cash flow projections take into consideration federal income taxes. If so, at what rate? Give me 1 second. Put a pin in that. I'll come back to you. All right. So, all righty. Can you guys, oops, you're seeing that. Oh, dang it. See, I need to learn how to do this better. I'm going to move you guys over here. Okay, can you see a spreadsheet or a PDF? Okay, yep. I see a couple of nods. All right, so this is what we do as far as a revenue and profit budget. So if we're calculating a DCF, this is what we're basing on. So here's historical over here, 22, 23, 24. Here's your projected 5 years then, okay? So if for us, what I'm going to do is I'm going to come in and make adjustments. So I picked on this one because we made some specific adjustments to this business because he actually had a doctor, this Dr. Rio, she actually left the practice. So we zeroed out her payroll moving forward. His contract labor was in, he only had it for 1 year to allow for that doctor who left, like they had to cover her for like half a year. So the contract labor ended up being zeroed out as well because they won't be there. Now, the other thing that we did was he had 3 offices. So Richmond, Grand Parkway, and Sugarland. The only one that he was going to keep, like these 2 of these 3 leases expire at the end of this year. And so we actually zeroed out these leases starting in 2026 or 2029. So when we talk about making adjustments to allow for certain things, this is what we're talking about. So to Eric's point about the EBITDA, Eric, if we needed to adjust these sales out here, so let's just say they had that one-time big jump in their revenue, we can actually come in here and make the adjustment down, okay? And to be able to reflect where it was sitting in 2023 or what have you, okay? So it kind of explains everybody's questions in one show and tell, okay? So this is what we do for this. Now, Ben, to help you be able to visualize what we're looking at as far as the value. So this is our calculated value here at 2.2. So our cash flows are 2025, 26, 27, 28, 29. Okay, so here's our free cash flow here. Now, this is the discount rate. So discount rate is, we calculate this from Kroll, like I mentioned. So basically what the discount rate, or capitalization discount, the only difference is this growth rate, is the inflation. So the lower the rate, the less risky the business. The higher the rate, the more risky the business. So being a doctor's office, less risky. People have to go to the doctor. Plus, he's an OBGYN. So a kind of a necessary doctor for those of us of the females. And even though we really don't like going and seeing him, we have to every year. So it's kind of a guaranteed industry, right? So it's less risky of a business. So here's your terminal value calculation. So free cash flow at the end of year 5. You're doing 1 plus the growth rate. The growth rate is 3%. And then you're taking discount rate minus the growth rate. So 15 minus 3. And then you get to do that to the 5th power. So here's this whole fun statistical algebraic funness that we get to do. So we arrive at a terminal value here. So discount rate, growth rate, free cash flow, 438, 211 goes here, calculated out to 1.8. Okay. So the discounted cash flow is 914,000. Add in your terminal value, so the value of the business at the end of year 5. Add in the cash. So when we come over here to this balance sheet at the end of 2024, was $28,139. So we added $28,139, and then the long-term debt. Now, here are some interesting things he had as far as his long-term debt. He took on, we went from $360,000 to $430,000 in long-term debt that he had to the bank, but he also ended up taking on a debt from United Healthcare. So apparently what had happened was that United Healthcare apparently had an issue in their system. And so they actually ended up doing basically short-term loans or long-term loans to the banks or to the offices that they worked with. So he actually was going to carry this for about 2 years, but not beyond that. It was actually going to be paid off by the end of this year, which is why you see it zeroed out on this side. But for the purposes of our valuation, we have to show the full $524,000. So the question to him, whenever he and I had this conversation, was if you're going to pay this off as far as the long-term debt, I can come back in and add this back into the total value of the business. So that's actually how we do our calculations of our discounted cash flows in one super quick, waha. Did that help?
Yeah, that helps a lot.
Awesome.
I actually have to drop for a seller call here in just a second, but my last question is, how do you forecast out the revenues? What methodology do you use for that?
I'm looking at historical, and I'm also going to look at industry comparison. So if I have a seller telling me, oh yeah, I'm going to grow by 25%, but I've only seen them grow by 4%, I got a lot of explaining, and I want to look at industry, and I want to see a lot of things happening. So revenue is not necessarily one specific method. We're looking at historical performance and industry information.
Okay.
But yeah, steal my email. I know you got to steal my email. Shoot me an email. We can jump on a call. Yeah, not a problem.
Thank you so much, Brittany. I appreciate it.
Okay, Richard. Cash flow projections taking into consideration federal income taxes at what rate? Help me out.
So you come down with a net income figure.
Uh-huh.
But there's tax that's due on that.
Uh-huh.
And taxes have to be paid.
Yes, they do.
I've seen some lenders that will net that tax out to come up with the available cash for debt service.
Mm-hmm. So I don't necessarily deal a whole lot in the debt service side of things. I only do calculations when I have to, and I have a spreadsheet that does that. There was literally a lender provided it to me. That's not something I dig into very much on my side of things.
Okay.
So I wish I had a better answer for you. It's just not something that I run into very much in my little corner of the world. So awesome.
Thank you. This has been good. Appreciate it.
For sure. Yeah, no, I love chatting with you guys. So, but yeah, you guys have other questions, things come up, there's something you didn't want to share with the class, then, by all means, let me know, and we can hop on a call offline for sure. So, Andy, I think the kids are ready to be dismissed from class today.